Hi everyone, Andrew here again. This is the final video in a series of videos I've been doing on explaining how you can take income from your pension fund, and I've been using this tub of jelly beans to help. Now if you've not seen those previous videos, I recommend you go back and look at them. But in this video I'm going to explain the death benefits for each of the options. Now starting with the annuity, depending on how you set up the annuity, the pension fund will die and be lost to you at some point in time. Now, if you've not included a husband or wife, once you die, the pension fund will be lost to your family. So that's one of the main reasons people don't really value them, but the value is in the guaranteed income for life. You might have chosen at outset to have a percentage of the fund being continued for a husband or wife. It might have been a third, half, 2/3, or the full amount. So if that's the case, if you die before husband or wife, that income will continue to them until they die, and then it'll stop. Unless that you've included what's called a guaranteed period, during which time, if you die within the first 5 or 10 years, the income that you were receiving will continue for the balance of that time, and then will change depending on whether you've included options for the spouse or not. So that's the annuity. Generally, it's lost on the first or second death. With the drawdown option, or if you've not touched the pension fund, it's a lot more beneficial because the pension fund, the remaining pot, can be passed on to husband or wife, or even future generations or charities that you've chosen. Now, if you were to die before age 75, it's free of any tax and it can be passed on to any of those people I mentioned. But once you get to age 75, tax can be an issue, because if the recipient, unless they're a charity, chooses to receive the fund in full as a lump sum to their bank account, the taxman will want to take their bit, and it will be assessed on the recipient's income in the year of receipt. So if they are a high earner or the pension fund is particularly large, they might find they're paying a large amount in tax before they get the fund. Now they could choose to keep the pension fund as it is, or have it as a drawdown fund, and then it can be passed free of tax, but they will pay tax once they start receiving income from the pension fund. So that basically explains the different options available for the death benefits and the advantage and disadvantage of annuity versus drawdown, or if you've not touched a pension. So I hope these pension videos have been of use. If you've got any questions, please do get in touch. And if you've not seen the other videos, please do go and watch those.